Hey guys, it's Joel with Interactive Trader, and Jeff brought up an interesting question on Facebook today, and I wanted to take a time and record a little video about it. And it is short-term vertical spread trading and the impact of implied volatility on your ability to do short-term vertical spreads. So I'm specifically talking about like 2 days to 5 day kind of vertical spreads. They're very, very popular because you can do them. They have a really high probability. Yeah, the returns are low, but because the probability is so high and you can repeat them so often that they look really, really attractive. There are some dangers in doing that though, and I talked about this a little bit on our Facebook page, but just to reiterate what the dangers are in that approach, that is number one, a very, very short-term trade actually doesn't have that great of a probability adjusted return on risk. Um, in other words, one loser can wipe out a whole lot of winners a lot faster on that type of trading style than it could on like 30 or 40-day verticals. That's probably the biggest problem. And the second problem to it is that there's no time to react if things do go wrong. It's basically an all or nothing trade. So you want to be really, really careful and be aware of the risks in that type of situation. Now, that being said, there are some things that you can do to give yourself an advantage if you're going to be doing those types of trades. And that comes down to understanding volatility. So I'm going to demonstrate this using our platform. So I'm going to share my screen with you guys, and hopefully this video makes sense, and we'll go into it now. Let me see here. All right, so what I'm looking at here is the S&P 500. And I want to demonstrate something, the difference between doing these short-term type of trades in a high volatility environment versus doing them in a low volatility environment. Now, very recently, really the end of January, the second half of January, the market was really, really scared. What was it scared of? The coronavirus coming out of Wuhan. That's what it was scared of. And at the very, very bottom of the market right here, see this giant red candle, everybody's panicking. Oh my gosh, is this going to impact corporate profitability? Is it going to make the markets go down? Well, you can see the market starting to sell off, but we're still in the overall long-term uptrend. That's the first thing I want to point out, is the overall trend long-term was still up. The next thing I want to point out is what volatility levels were at that time. And I'm going to do this, I'm going to use the VIX to be a barometer of overall market volatility. Let's take a look at the VIX, and I want to show you what the VIX did at that time. So January 31st, the VIX spikes up to where it closes at 19, really, really high relative to where it has been. Now, what I am going to do is I'm going to compare two different dates. I'm going to compare the January 31st to a time when volatility was really, really low on January the 17th. Those are the two times that I'm going to compare. So I'm going to do a trade first of all on January the 17th, and I'm going to use SPY to do this trade. And we're going to go really far out of the money with a really short-term vertical spread. Let's go into it. So I'm going into the options here. And I'm going to use our back testing tool that we've got on this platform. Great, great tool for educational investigating. I'm going to go a month ago here, January 17th. That's when volatility was really, really low on this. And you know what? I don't want to do this on a Friday trade, so let's change this. Let's go, well, you know what? Yeah, we'll keep it easy. We'll do a Friday trade. So on January 17th of 2020, volatility was really, really low in the market. And let's say we were going to do like a 1 week vertical spread, or even closer. Let's do a 5 day. Let's do a Wednesday expiration, a 5 day trade. Now, 2 of those days were weekends. So essentially that turns this into a 3 day trade, right? So I'm going to go into Wednesday. What I'm going to do is I'm going to go really, really conservative here. I'm going to go 15 deltas. It's really far out of the money for what's essentially a 5 day trade. And I'm going to sell that at 329, and then I'll buy like a 327. Now, your initial reaction might be, oh my gosh, you're not getting any money for that. But remember, guys, this is just 3 trading days. You're getting 11 cents on this trade. It's a $2 vertical. That means you're risking 189 in the trade. Now, that's not a fantastic return on risk, but it is good when you take into consideration it's literally only 3 market days. So I'm going to pull up a calculator here. Take 11 divided by 189. That's 6% in 3 market days. Now, if that's not good enough for you, well, I don't know what to tell you. So that's the first thing we want to look at is, hey, we're making almost 2% a day while the market's open on this. Now, of course, if you want to include the weekends, you're saying, hey, it's a little better than 1% a day. Still a fantastic, fantastic return. Now, the next thing I want to look at is how much wiggle room did that give us on the stock? How much wiggle room did we have on that? So you can see on that day, the stock was trading for $331.95. Now, I'm just going to round that up to $332. And we were giving the stock $3 basically in wiggle room. Now, let's come back to our chart again. That was on January the 17th. Stock was right here, basically trading at 332. And we were saying, hey, as long as it doesn't go below 329 in the next 3 trading days, we'd have been okay. Let's see, where are we here? So we're giving it about that much wiggle room. Not a lot of wiggle room, but again, remember, it was only 3 trading days. And actually, in this case, it would have worked out just fine because 3 days later, it closed right there. You would have made your money. It would have been great. Well, now let's compare this to doing the exact same type of trade on the 31st. So just as a reminder, we were giving the stock about $3 in wiggle room and making 5.8%. I'm going to write those numbers down right here so I don't forget. Now let's look at what it would have looked like if we'd done the exact same trade on the 31st when volatility was really, really high. Going to January 31st. Again, I'm just going to stick with a 5-day trade. We want to keep things the same. Trade, compare apples to apples, right? So I'm going to a Wednesday expiration, going somewhere around 15 delta. There we go. I got a 15 delta at 312. I'm going to keep it a $2 vertical spread. Same as we did on the other one. Now, the first thing I'm going to point out to you is how much more money we're making. We're making 18 cents instead of 11. Now, that might not sound like a huge difference, but let's do the math. Because now, still a $2 spread, right? Now we're making 18 cents, risking 192, or excuse me, 182. If we do our return on risk on that, 18 divided by 182, now we're up to almost 10%. We'll call that 9.9%. So our return on risk is much, much better, but that's not the entire key here. Let's look at what else we've got. On that day, the stock was trading for $321.73. We were selling the 312 strike, which means we're giving it almost $10 in wiggle room. Let's see what that looks like on the chart. So that was this big red candle day. We were giving it that much wiggle room over 5 days. So you can see if we put on this type of trade in a high volatility environment, not only are we getting a better credit, we're also actually in the real world giving ourselves more wiggle room on the stock, therefore a higher probability of success. You can see the size difference between those 2 lines. So understanding these little things like how is volatility impacting your trade, how's volatility impacting the value of your options can actually make a big difference in when you would want to put this type of trade on versus when you wouldn't. Just to spell out the numbers for you guys. In a low volatility environment, we were giving the stock $3 in wiggle room. And we were getting a return of 5.8% in 5 days. When we did it with in the high volatility environment, we were giving the stock $12 in wiggle room. And we were getting 9.9% in 5 days. It's a pretty big difference, isn't it? Guys, make sure you understand how implied volatility is impacting your trades. Please make sure you understand that. I'm sorry, did I get the, hang on, I got to make sure I got the number right. Excuse me, sorry, it was $10 in wiggle room, $9.73 in wiggle room. Sorry, I wrote the number wrong. Scratch that out. It was $9.73 in wiggle room that we were getting, and getting a 9.9% return on that. So we were giving the stock 3 times as much wiggle room and getting a better return when volatility was really high. So please, as I was saying, make sure that you understand the impact volatility is having on your trade. Use that as your advantage. Use that to create your edge for knowing when it's the time to use which strategy. As always, guys, thank you for being here. Thank you for being part of our team. Have fun out there. Stay safe. Go make some money.